Nick, we'll talk about the external refinancing adjusted values and what this now tells us about where the refinancing piece is.
Yeah, I'm just going to go through some of these charts really quickly now because they all sort of tell the same sort of story. So external refinancing. So this is somebody with a mortgage and I'm going to refinance it and I'm going to take it to a new lender. So again, a year ago, the mortgage wars were underway and we saw a lot of refinancing happening. That's sort of slowed down. It's still not got back down to what I call historical levels. It's still actually pretty high if you look at, where we were. But, you don't have to be a mortgage broker to work out that the mortgage wars have stopped. What I do find really interesting, and I'm just at the moment trying to get more data on this, and there's actually not nearly as much data around, is what's happening in the business market. So your business loan, and here I'm talking about a classic, $10 million own a commercial property, that sort of loan. There seems to be that the mortgage wars have moved from the residential game into the commercial business lending game. And we're seeing really cutthroat rates happening, really aggressive deals, whether it be from the major banks, whether it be from the private lenders. Everybody's now trying to get into this game and win business. So there seems to be a lot of refinance going on in that sector. So I just make that comment. So here we are. Again, a problem for the RBA. So new loan commitments, personal fixed loans. This is car loans. So this is not your payday lenders. This is fixed term. This is, I'd like to buy a new car. Thank you very much, Mr. Car Dealer. It's not slowing. It's just, basically running at record levels. Not good for the RBA. Good for mortgage brokers, potentially. Your shorter term stuff, so this is getting more into your payday lending sorts of things, much more subdued. So again, your battler is actually finding it harder. You'd think once the battler finding it harder, they might turn to payday lenders, and well, not so much payday lender, but short-term lenders. They actually, don't. Payday lenders, perhaps they do, but borrowing money to buy a new TV, maybe not. I'll just make do with the old one. Thanks very much. That's a lot more subdued. Business finances we talk about on the way up. So again, consistent with what we're seeing.
Nick, I might just pause there for one moment. Stephen, in terms of what I wanted to do, Nick, before we get into business, can you just pop up to the graph before, please? I'd just like to get your indication, Stephen, about consumer sentiment at the moment. So, we were talking about people sitting on the fence for longer in the residential space, and we work with a lot of commercial lenders, and that's definitely consistent in the business finance space as well. People are sitting on the fence longer. Inquiries are taking far longer to convert. There's a much greater level of drop off and so forth. And the sentiment that I've been discussing with the lenders that we work with is that just consumers are on the fence. They're very cautious about any spending. But having said that, these graphs buck what I'm hearing a lot in the market. So I was just, from a consumer sentiment perspective, whether that's an individual or whether that's a business borrower, I'd just love to hear your take about where you feel individuals and businesses are at the moment in terms of their psyche.
Yeah, I think that what always plays a really big part of when you talk to the consumer is what's on Channel 7 News, what's on Channel 9 News, right? And my father-in-law was a very, very successful financial planner. He retired on about 4,000 clients, and actually he came to Australia when he was 21 years old, couldn't really speak English, was an accountant's clerk for the first kind of 20 years of his career, and then when he was 40, basically became a financial planner once he could speak English, right? And what he always just basically summarise is the smart people will basically do the opposite on what's on the TV, and the gullible people will listen to basically what's on the TV, right? So, for someone basically like me, as I said earlier, I think that when the interest rates basically drop, that will put an upward trajectory basically on property prices. So for me, the perfect time to enter into the market is basically now, because I think people will basically realise that equity right. And then the other thing is, if they're obviously renting, they're paying off someone else's mortgage and not building their own financial position, right? And when you look at basically the demographic of what comes on a current affair and those type of things, it's not the person ever that basically owns 1, 2, 3, 4 properties, right? It's the person that basically getting the pension, hasn't done the right things with their money, usually basically over the time frame to put themselves basically in that position. So what I'm kind of seeing is the smart people will basically they'll enter, they'll basically take a medium to a long-term perspective on what they're basically doing. It could basically well be that, we do basically see some dips in prices, right? But they're paying off their own mortgage versus building up someone else's financial position. And I think that there will be the large, basically a masses of people that will basically be really waiting for that RBA announcement and be listening to basically what happens on the news before they pull the trigger, Sasha. So that's what I'm kind of seeing there.